everyone, I'm Deborah, one of your module leaders. In our last video, we looked at why auditors take a risk-based approach using the AAA case study from Unit 19. In this video, I'm going to show you how we understand the entity and its environment using the same case study, which will help us identify the risks relevant to the audit. Make sure you've got your CSG handy so that you can refer to it as we go through. Let's get started. ISO 315 Revised makes it very clear that a risk-based audit approach can only be accomplished through understanding the entity and its environment, including the entity's internal control. So let's look at what the standard means by the entity and its environment. Here's the entity we're going to audit. It's got a mission statement and a plan to carry out that mission. These dictate the nature of its operations, how it's structured, what it invests in, and how it's financed. Management will select and apply accounting policies for the entity and measures used to evaluate the entity's performance. But the entity doesn't just operate in isolation. It exists in an environment, and the characteristics of that environment have a significant effect on the entity. ISO 315 Revised groups these characteristics into three facets: industry, regulatory, and other, and gives some examples of these. Now that we're across the basic framework, let's apply that to the Monty Travel case study. Our last video covered Monty Travel's objectives. Just click here to review. But how is it going to achieve those objectives? Well, take a look at the background information and see what you can find out about its strategies. Hit pause, then press play once you've got your answer. Alright, hopefully you spotted these strategies from the background information. Selling package holidays in Australia and New Zealand, expansion into Asia and Europe, only selling its own packages, selling through its branches or online through its website, and a strict pricing policy. But how do these strategies drive the nature of Monty Travel's operations, structure, investments, and financing? Write down one or two things that you can think of for each of these, and I'll see you when you're done. Let's start with operations. You should have picked up that Monty Travel has a network of branches in Australia, New Zealand, and Asia, supported by head office in Perth. It has 3 product lines: family, explore, and couples packages, and its online booking facility is relatively new, was expensive to build, and has not been as successful as hoped. Structure-wise, we're told that Monty Travel is a listed company, and we've got an organization chart showing its governance structure. Despite this, Monty Travel is still very much a family-run business. The founder, his wife, and his daughter all hold important positions. Investments is pretty straightforward. Besides the website, Monty Travel also implemented a new ERP system this year. Finally, Monty Travel finances its operations using a capital structure that has a debt-equity ratio of about 2.2. Its contributed equity of $3.5 million is probably made up of ordinary shares which are listed on the ASX. Its debt includes the $5 million interest-bearing bank loan used to develop its website, which has 2 covenants attached. Just like risks, we could come up with more, but this is a good start. Now, see if you can identify the accounting policies and key performance measures that Monty Travel's management have applied. Hit pause while you work, and I'll see you after the break. When auditors consider management's selection and application of accounting policies, they're not thinking about a company's accounting manual. Rather, they're focused on what the key accounting policies are and any changes in line with a risk-based audit approach. Here, the focus is on Monty Travel's revenue recognition. There's a couple of interesting questions here under IAS 18, like the principal agent gross versus net presentation of revenue, and the timing of when deferred income can be recognized as revenue. There's also the issue of how IFRS 15 will impact Monty Travel's revenue recognition when it becomes effective. Don't worry, we're not going to get into these questions for AAA. Our focus is on applying the auditing standards. But it is important to remember that you've got to understand the financial accounting before you can audit it. There's not much on performance measures, but we can use the information we have to infer what the measures might be. Total sales, some type of cash measure like cash levels or cash flow forecasts, some type of profit measure like profit before tax, net profit, or EBITDA. In real life, you can find out more information by talking to management and looking at documents like management reporting packs. The math module looks at all of this from management's perspective. ISO 315 Revised has a lot to say on this, so make sure you check it out. So we've just finished understanding the entity, Monty Travel. Now we need to consider its environment. Let's start with industry. What are some of the characteristics given in the background information? Hit pause and see what you can come up with. Ready? Here's what I have. The increasing popularity and availability of the internet has changed how customers choose to book their holidays. As a result, Monty Travel lost market share to online competitors. Even though they now have an online strategy, it hasn't been enough to turn things around. Monty Travel relies on third-party suppliers, usually ones that it trusts. However, its recent expansion into Asia forced the company to use new suppliers, and unfortunately, some of these new suppliers have had health and safety issues. Finally, the travel industry is subject to seasonality. Now, what about Monty Travel's regulatory environment? Pause and name at least one or two things before you go on. The reporting framework is easy once we know Monty Travel is a listed Australian company. It's probably the same as Flight Centre, a comparable company. Here, we can see the framework is Australian Accounting Standards, and also IFRS, and the Corporations Act 2001. There's not much about laws and regulations, but again, we can extrapolate. In addition to the Corps Act, Monty Travel would have to comply with other Australian legislation like tax laws and ASX rules and regulations. There could also be industry regulations, some mandatory like the IATA accreditation to sell flights, and some voluntary like AFTA's travel accreditation scheme. Can you think of any other environmental factors that might affect Monty Travel? Take a moment to pause, then hit play to continue. One factor is exchange rate fluctuations, since Monty Travel is exposed to a number of different foreign currencies. Another factor is movement in interest rates, since Monty Travel has an interest-bearing loan with the bank. Monty Travel already has $5 million of debt, so this could affect its ability to borrow more money in the future. But since it is listed, Monty Travel might be able to raise some money from shareholders more easily. In real life, auditors can gather more information about the environment by looking at evidence like industry reports or leveraging their experience on other clients in the same or related industries. There's a lot to take in when we're understanding the entity and its environment, but you can see how the standards framework helps auditors identify and assess risks, which we went through in the previous video. Remember, ISO 315 Revised is illustrative, not exhaustive, so don't fall into the trap of thinking you've got to check off every single box in this diagram. So, how'd you go? Share your thoughts and any other questions you have in the comments below or on the discussion boards. I hope you enjoyed watching, and I'll see you next time. Bye. Check it out. Look, tours for Pokemon Go. Think maybe we'll finally catch that Ditto? Yeah.